More than 10 million people in the UK are either receiving pensions from a so-called defined benefit scheme or expecting to. For many of them, the current uncertainty has been a significant worry. Well, here to answer your questions is Tom Selby, Head of Retirement Policy at AJ Bell, Chief European Economist at Bloomberg and former official at the Treasury, and Claire Scott, Divisional Director of Retirement and Holistic Planning at St James Place Wealth Management. And I don't think I said your name, Jamie Rush. So thanks very much indeed for joining us tonight. We've had so many questions. You know, I mean, my pages are full. People are incredibly worried about this, obviously, of course. Let's start with this question from Susan, who says, could this economic crisis take all my private pension? I've already seen it reduce by about £7,000. Tom Selby, let's start with you.
So no, there shouldn't be a risk of anyone losing all of their pensions. I think one of the more damaging things about what we've seen in this crisis is actually that pensions have been dragged into it at all. So the problem that the Bank of England has been trying to deal with is a sell-off of government bonds. Now, pensions have been dragged into that because defined benefit pensions are big holders of government bonds and we're potentially going to sell off a lot of them. But in terms of the safety of people's private pensions, what we're seeing here is going to make no difference whatsoever, except for people who are highly invested in government bonds. That'll be a very, very small number of people. The vast majority of people are going to be absolutely fine. The key thing for defined benefit pensions is the solvency, the safety of the employer that stands behind the guarantee. As long as that employer remains in place and it has a legal duty to pay the pensions that it's promised you. So provided the employer is still there, then your pension will be safe. Even in that extreme scenario of the employer going bust, there's the Pension Protection Fund, which stands as a safety net to stand behind those pension promises if something does go wrong.
OK, Claire Trott, Abe is asking, is it best to freeze my pension investment account until things settle?
Well, it really depends what they mean by freeze. I mean, it's not really possible to freeze your pension in that. So there's a lot of things you see that are there that say my pension is frozen, which people mean when they leave. Well, that isn't actually what happens. Even in the defined benefits arena, they will continue to grow dependent on the rules of the scheme if you were to opt out of the scheme. But opting out of the scheme just means that you're not building up any more benefits. And actually, that's really going to be a detriment in the long run to your pension planning. If what you mean, if you're actually invested in the stock market, should I put it all in cash? Well, again, that's a really difficult decision to make because the stock market fluctuates. It's a long-term investment. And by putting it in cash, all you're going to get is interest, if you're lucky, depending on how you put it in there. So it's a big risk to actually make any rash decisions about anything at this point. The key would be to get individual advice for you personally to look at what your pension is, how it's invested, how long you've got to retirement. If it's a defined benefit, as Tom said, it's protected under a variety of different regimes. So firstly by the employer and then by the PPF. So opting out is rarely likely to be in your favour.
Yeah, I guess people are also concerned that maybe with the cost of living crisis, putting less into the pension when that pension might also go. But that's very sound advice, Claire. Thanks for that. Let's take this question about government gilt. And we'll bring you in now, Jamie. Mike is asking, will government gilt settle down and still be a safe investment for pensions? What's your assessment, Jamie? Do you think government gilts will settle down?
It depends very much on what the government does over the next few months, the next few weeks and months. The reason we have a problem is that the markets have lost faith in the government's competence. They think that the fiscal plans are irresponsible, and so they need more compensation to hold gilts, the debt that the government issues. Now, there are a couple of ways forward. One possibility is that he might U-turn on the tax measures that have been announced, the giveaways. that would win credibility with markets most likely and probably help to bed down borrowing costs for the government to some extent. The other possibility is he spells out a large package of spending cuts, perhaps. That may not be viewed as credible in markets, and that might not solve the problem for gilts. So I think, right now, most people in markets are expecting that government borrowing costs are going to stay very high, and therefore the value of those gilts in your pension portfolios is been reduced, and there's a possibility that will be permanent.
Okay, let's take a question from Neil, who says, I have an invested pension pot which is seeing large losses in value. Is there a risk I could lose everything? That's the same concern that I'm sure many of you watching are having and asking again. Tom, let's bring you in again. You're saying that it doesn't matter what kind of pension you have, there's no risk of losing it? Is that or not?
So there shouldn't be a risk of you losing everything. So we've got two different types of pension scheme here that people are talking about. And again, I think one of the challenges with this is that people are reading headlines saying pensions crisis, and they assume it affects all type of pensions, and it doesn't. So we've got defined benefit pensions where the key thing is that the employer is solvent and has to stand behind the promise regardless of what happens under the bonnet of that pension scheme. And as I said, the pension protection fund exists as a safety net, even if that sponsoring employer goes bust. You've then got defined contribution pensions where your money's invested. And again, only those people who are very heavily invested in government bonds will be seeing big falls in the value of their pensions. Most people will be invested in a diverse range of investments all around the world. And so what's happening in the UK, it's a very UK specific problem we're seeing here. Now, lots of people will have experienced investment falls over the past 12 months, over the past 24 months, but that's part and parcel of long-term investing. If you're investing in a pension, your time horizon is going to be over decades rather than a few months or a couple of years. So you should be able to ride out any uncertainty we've got at the moment with the aim of achieving that long-term growth over time.
Right, interesting you say that. So let's pick up this question then, because this flows nicely into it, Tom, and all of you, of course. Jackie is saying, I see my private pension dropping lately. I have under 5 years until I retire. So clearly she's worried this is coming soon. Should I take my pension now? Tom, look, we'll pick up because you were mentioning that, you should be able to ride it out. That's 5 years away. Should she take it now?
It depends what she means by take it. So I can't give individual advice based on people's own personal circumstances, but there are various dangers if you just take all of your pension out now. So you'll potentially end up paying more tax than you might otherwise do because you could push yourself up into a higher tax bracket. You're also taking your money out of a very tax efficient environment, and you might potentially be shoving it in a bank account, for example, and you might be earning very little or no interest on that money whatsoever. I'd suggest if anyone who is suffering big falls in their investments at the moment needs to have a think about what their investment priorities are. Now, it's possible that this person is invested in what's known as an annuity hedging fund. So that means that as someone approaches retirement and plans to secure an income with an insurance company, which is what an annuity is, they'll move into bonds, which move in the opposite direction to annuity rates. So if the plan is to buy an annuity, then what they'll be experiencing is a fall in their fund value, but the level of annuity they'll be able to buy with that fund will be increasing. So if that's the case, then the fall in the fund value isn't necessarily something to be concerned about. The area of worry.
Let me bring in. Sorry, Tom. Let me bring in Claire here, because Claire, I expect you're getting a lot of similar questions to this at the moment. What should I do? Should I pull out? Should I stay the course? And stuff like that. And I'm going to tack on another question, Claire, which is from Addy, which says, what actions can I take to protect my pension? So if you bring in the last question and what actions people can take to protect their pension, Claire?
Yes, certainly. I mean, I totally agree with Tom. I mean, there's so many different things going on here that we can't give individual advice over this very short period of time. And as I mentioned earlier, you know, personalised advice, even personalised guidance from the available bodies to talk about what your options are with your pensions can really add value to try and understand where you're sitting in the market as well as when you're coming to retirement. It really depends on, as Tom said, what you're planning to do. A lot of people, it's not just an annuity that people are looking at these days. People are looking at taking retirement over many, many years, changing their working pattern, reducing their hours, just taking a little bit here and there. And taking that little bit just because you need it is not going to suddenly impact, you know, all your investments, but moving to possibly, you know, less risky investments if that's appropriate for you, or as you say, taking a little bit and riding out keeping the rest of it invested. But taking it all out or putting it all in cash is actually a really extreme move in these markets when we're seeing drops or fluctuations, because something that happens one day could bounce back the next day. I'll take you all the way back to COVID. We had massive drops in the market on one day, and by the end of the week we were back to normal. I'm expecting this might be a little bit longer, but we don't know what's going to happen. We don't know what's going to come out on the 31st of October when we get the statements from the Chancellor, and things will change, and things might change quite quickly. So making any rash decisions now about changing your investment portfolio or taking money out of pensions could have a real detrimental effect to your long-term planning. And pensions are long-term. We may only have 5 years until you retire, but that's 5 years till you start drawing an income, not 5 years until your money runs out, or until, worst case scenario, we all will eventually die. And that's when we want our pensions to run out, at the point of death, or, you know, leave a little bit for our beneficiaries in the long run. So it's not a case of what do I need to do before I hit that date where I want to stop work. It's considering that and the longer term and how you're going to fund it over all that period. So there's lots of things to consider, and it's not just a case of I've got a date in mind and I need to work towards that anymore.
Okay, so clearly the advice for everyone watching is don't panic and try and stay the course. I think you've also answered. I just want to mention that, Tim, you also sent a question to us very similar. So I think that's just been answered. I'm extremely worried. I'm due to retire in January. I see my fund has lost approximately 10%. Should I delay? So hopefully, Tim, that answers your question. Let's come back to you, Jamie. Bob is asking, if our pensions fail, who do we turn to?
Again, just to echo what Tom said, and Claire as well, is that it depends what sort of pension you're describing here. If it's a defined benefit pension, there are protections in place that even if the company that is providing it goes bust, then you're still going to receive your pension. That's for people who have a fixed return that they know they're going to get. There are other people, which is probably, and there are many of them, who just have pensions that are invested in stocks, and so what you get back in future years will depend on how the assets in that portfolio perform. And I think the thing that is important to recognise is that for those people who are now reminded to look at their pensions and see what they're worth, there is a substantial global element here. So most pensions are invested in countries all across the globe in a big selection of different assets. And global equity prices, global bond prices have all fallen. And that's because central banks like the Fed, the Bank of England, the ECB, they're all lifting rates to try and fight inflation, and that's pushing down on asset values. And that is something which may persist for a very long time. So I think it's important to distinguish that there are things that the government are doing which are unhelpful certainly to markets. They're unlikely actually to be having an immediate direct effect on pension pots that are invested globally. It's really there's other stuff going on as well, which is pushing those values around, and they may be quite persistent trends. I mean,
to all of you, really, I mean, how can we allay people's fears who are watching? Obviously, we're trying our best to do that by going into the nitty-gritty and explain how this all works. But people are extremely worried. You know, they've worked hard all their life. There's a cost of living crisis. They've put their money in for a rainy day, as we've always been told to. You know, get your pension. It should be safe. And now there's all this fear about pensions. Anyone can come in, really, if you want to answer that, or...
So I think all we can do is reassure people. So part of the challenge of what's happened here is that pensions, in a way, have been caught in the crossfire of much wider events. And part of what's been exposed here, I think, is people's lack of understanding of pensions and how their pensions work, and the very fact that their pensions are invested. So a lot of the questions I've been dealing with today have been people who are fundamentally confused that the value of their pension could go down over the short term. Now, that's absolutely nothing to do with what we're seeing at the moment. That's just the nature of long-term investing. Now, clearly, nobody's going to be popping any champagne corks at the moment because things have been very difficult. But I think one of the big challenges we need to get over here is the fact that people just don't understand this stuff. And you've got to keep driving home this message that actually most of the time your pension is going to be safe, because in the current circumstances, that is absolutely the case.
Yeah, that's great. Thank you. I think that's what sometimes when we have these question and answers with experts and you're all so knowledgeable, it can be quite overwhelming, can't it? And it's just nice for people to understand. As you say, a lot of people don't understand how this stuff works. And we are constantly talking here at Sky News, certainly about the economy. We're really trying to explain to people how it all works. So let's move on then. We've got more questions. Simon is asking, should I continue with extra payments into my pension at this time? Slightly a different question about, people still worried about putting their payments in. So Simon, Claire, let's ask you. Simon's asking, should he still continue with extra payments at this time? Is that about affordability? I guess
it is really. I think truly it is about affordability. It's about the cost of living as well. We would always encourage people to continue their contributions. Paying in a fluctuating market can be just as good as paying in if the market is stable, because when you buy into these stocks and shares, as I said, things fluctuate on a day-to-day basis. They call it pound cost averaging, another horrible bunch of jargon that we don't want to get into today. But basically it means by buying it on different days, you're spreading the risk of buying at a higher or lower rate. And therefore, in the long term that Tom's talked about, that you can actually get a real benefit from doing this. So rather than putting it in a cash account and sitting there and waiting until you suddenly see the market going back up, when you're likely to not time it and try and put it in and you've already missed out on the market going back up, putting it in on a regular basis and getting your tax relief on a regular basis, really important, because that's actually why we're investing in pensions in the first place, is to get that good tax relief. Can actually make a really good long-term plan. We always look at a thing called the cost of delay. And the cost of delay is not doing something today. And how much would it cost me if I then have to try and play catch up? And trying to play catch up on pensions can actually be quite difficult, because you need to make sure you've got enough earnings for tax relief. You need to make sure that you can meet all the other requirements. So I would, if it was me and I could continue to afford to do it, then I would be continuing personally to make those contributions and take advantage on the current prices that you're buying into the market at. Because we do hope, and generally we have to say, the market does go up in the long term. And as we say, these are very long-term investments.
Okay, let's take a question from Martin now. Martin, you've written in saying the Bank of England are buying gilts from pension funds. I understand there are other tools they can use. What are they? Jamie Rush?
So the problem is that the pension funds are having to sell some of their assets, in this case it's long-term gilts, to be able to post something which is called a margin call, and it's basically they buy insurance against movements in asset prices, and they have to post a certain amount of collateral to be able to finance that. So what they're having to sell these bonds, and there's no one who wants to buy them, which means that they're making huge losses. And it makes the problem worse. The more they have to sell more bonds, and it's just feeding in on itself. So the bank is trying to stop this kind of cycle, this vicious cycle, from establishing itself by being a buyer for these bonds. They are doing that. They could do it for quite a long time if they needed to, I think, to keep a floor under prices and stop pension funds, these particular pension funds, from becoming insolvent. It's one option. There are some other options. The government itself could step in and design a scheme to bail out pension funds so that this kind of cycle doesn't persist. That's one other option. The Bank of England could also buy some of these bonds, but also sell some at different lower maturities. So the problem is very specifically located around very long-term gilt, so 20, 30-year bonds that the government has issued. The bank could buy those, but sell some 2-year or 5-year bonds, and it would probably be able to do that without causing any dislocations at that end of the market. So the bank has options. It's for them, it's just presentationally awkward because they don't like to be printing money to buy bonds.
Right. This is an interesting one from Al. Are public sector pensions safe? Are they, Tom?
Yes. Yes, they are. Public sector pensions are the safest kind of pension that you could possibly have because they're backed up by the taxpayer. So provided that the UK as a nation state doesn't go bust, and if that happens, then we're all going to be in quite a lot of trouble, frankly, then your public sector pensions should and will be safe in the same way that defined benefit pensions in the private sector are going to be safe. They're safe, but they're extra safe because they're backed by the UK as a country.
Fantastic. Okay. This is from Anna, and I'm going to put it to Claire. Anna is asking, I'm a young person who has not yet started paying into a pension fund. Is it even worth starting to pay into a pension scheme at the moment? Good question from Anna there, Claire.
Great question. But yes, again, we're back to that cost of delay. You start now and you start small. And it gives you all that scope to build up all those funds in those many years until you get old and wise and come to retire. It's really important to remember, though, if you are employed and you're earning £10,000 a year, your employer should be putting you into a workplace scheme. The important thing with that is that they will make a contribution too. And if you choose not to be a member, they get to keep that money. So we're not saying that we don't want them to keep that money, but we're saying we want them to put it in the pension for you so that you get that benefit. It's in essence free money. It's extra salary that you will get if you join your workplace pension scheme. So really important. Auto-enrollment was a great invention brought in 2012 and has actually put so many more people into pension savings. So please do not waste it. Do not waste that free money and take it where it's available. And if you can afford to even put the smallest amount away, all that long-term saving, compound interest, more horrible jargon, will continue to build those funds, and that you'll be in the market for a lot longer. And hopefully, you will outride all of this, and everything will become great, and you'll have a wonderful retirement. Just because you started sooner rather than later, it should, in theory, cost you less.
Okay, that's brilliant advice there. I think a lot of people don't realise about pension schemes at work as well. I know I didn't when I was much younger. Okay, we've not got long left, and I have two questions. I'm going to put them together. They're kind of similar, really. Russell is asking how, after a short period of market turmoil, can a fund even be at risk? And Jeremy is saying, I know pensions are a long-term project, but will they recover and increase in the future? They want to know that there's going to be recovery. Tom?
So just got to keep driving home this point. The pension funds aren't at risk. So there are specific issues with investments within defined benefit pension schemes that have led to collateral calls, so demands for cash from those pension schemes. But provided the sponsor sitting behind defined benefit pension schemes is strong, then your pension will be safe, and there's the pension protection fund sitting behind it. Now, in terms of general market turmoil, we are, if you're going to invest for the long term, you are going to experience periods where things are bumpy. We've experienced it in 2016 with the European Union referendum. We experienced it in 2020 with COVID. Back in 2007, 2008, we had the great financial crash. These things are part and parcel of investing. And actually, the fluctuations we've seen in stock markets and in the value of people's pensions over the last 2 weeks, 2 months, and nothing unusual at all. And I think part of the challenge here is to educate people on the fact that their money in a pension normally is going to be invested. And so it's going to go up and down over the short term with the aim of achieving long-term growth. So a big educational challenge here, I think.
Thank you, Tom. Hopefully we've done that tonight. Thank you so much for answering all those questions. I mean, they were similar in parts, but broad too. So that's great. Tom Selby, Jamie Rush and Claire Trott, thanks very much indeed for your expertise tonight answering your questions.